What are kind of some of the challenges you see in underwriting in general, specifically, I guess, in development projects? We'll touch upon some of the other use cases as well, but given our audience and kind of what we're dealing with here, with kind of the housing, affordable housing crisis and shortage here, there is a push for more development, but locally here, it's always land costs are too high. Expenses for labor and unionized labor, and there's a lot of politics involved that drive the costs higher. So tell us more, share about kind of some of the projects that you've helped underwrite. What were some of the challenges there that they faced?
Yeah, and I'll go first. Yeah, I think the main challenge really with any underwriting a deal is that the clients come to us and hey, here's my baseline assumptions, right? And I'm going to rent it for this, I'm going to build it for that. One is they realize that they're going to have to get a little more aggressive on some of the assumptions, right? They can't be too conservative because the numbers aren't going to make sense. They're not going to be able to go out and raise capital, based on those numbers. So there are a lot of levers that you can pull to tweak the aggressiveness of the models, and that's one of the things we help them with, right? We kind of guide them through, hey, here's your base case, right? Your base case, you probably need to do something different here. You want to grow rents at 3% instead of 2.5%, or do you want to cut your expense margins or whatever it may be? And so that's kind of one thing that people always struggle with. Another thing that people struggle with is they have a structure in their head about, hey, I'm going to go out to market and I'm going to raise capital based on these terms. And then once they actually go out and start talking to investors, they realize that, investors want different terms. Okay. And now they're going to have to go back and kind of, polish the model again and the numbers, and okay, wait a minute. Okay. The investors are asking for this sort of preferred return and these sort of metrics. And, I need to kind of, rethink my offer to them. And so that's, really you want to, do all that kind of behind the scenes, right? Before you go out and go start talking to investors. And so, again, that's kind of one of the things is like, okay, wait a minute, what are the terms that are happening in the market right now, as far as preferred returns and splits and promotes and things like that. So when you go to market, it's like, oh yeah, this investors are used to seeing this type of thing. Right. And it's kind of crazy because, some people will come to us and say, oh, I want 10 tiers of a waterfall and I want it to go from 0 to 100. And it's like, okay, that's too complicated. Okay. Let's make it a little more simple. Right. So people can understand exactly what they're going to be receiving from this deal. And so it's a lot of, you want it to be complicated, but you also want it to be simple at the same time. So kind of getting people in that right headspace is what I see is one of the main issues. And maybe Chris, you can talk more about maybe developments specifically.
Yeah, so I'll piggyback off of what you were saying a little bit there. One huge issue that we see, and this is uniform across the board, is to what Eric was saying, a lot of people have the idea in their head and then they even go out and negotiate terms with their LPs. But then time and time again, we've seen issues where what they communicate with LPs, they go and tell their legal team, and then different terms end up in the docs, but not enough thorough review is done. And so something as simple as compound versus simple interest can mean hundreds of thousands of dollars of promote misallocation. And so we see that sort of thing all over the place. And we even have people come to us and they say, hey, no, our waterfalls are getting audited. We know they're accurate, but auditors aren't experts in waterfalls. They're smart people, but it's the waterfall world is a very convoluted thing. And so that's one thing we see a lot of is, hey, you can communicate with your legal team, but make sure what you want is actually in the model. And what you have in the model is what's in your legal doc. Otherwise, you're going to be in for a surprise, 3 years, 5 years down the road when you go to sell your project, and you either get way more or way less than what you originally bargained for. But on the development side in particular, one of the most convoluted things about modeling that out has to do with tax credits that are available to people. This year in particular, we've been doing a lot of residential kind of single family land development, both horizontal and vertical and combinations of the two. Depending on what municipality you're building in, what state you're building in, you could have any number of different tax credits, any number of different municipal funding programs, all of which are calculated completely differently. And there's not a one size fits all approach to that. And so if you're going and doing a ground up development and you need to figure out how to communicate this tax benefit to your LPs or the subsequent or the subsidizing source of funding, it's difficult to do because you can't really have a template that has every single function in there. And so we do have to, step in and do some more advanced modeling and that side of things, because it can be very material dollars. And if you do it wrong, then you could have underraised your equity, underquoted your debt. There's a lot of issues that could come up. So that's one thing we see, in the world of COVID. I don't know if you paid attention to the price of lumber in particular, but everyone's estimates, futures on lumber this year are up 50%. And so costs of everything are, you just hope you baked enough contingency into your projects that it's not going to be an issue. But, the budgeting, the debt side of things, how much IO can you really get away with? Everyone wants to say you're going to have an IO loan as long as you hold the building. That's not reality. Factoring in the guarantee on debt, someone has to be guaranteeing, otherwise you're going to be paying a huge interest rate. And so, there's a lot of barriers to entry. You just got to consider all of them. And then, make sure you have it modeled out, because if you don't model it out right, don't bake in enough contingency, then you could be in for some real trouble down the road.
Yeah, exactly. And kind of to that point, the debt side, really understanding, whether it's tax credits or mezz loans or opportunity zone tax credits or whatever it may be, you got to understand your capital stack, right? Because you're going out to your LP investors and you're raising capital, right? You're raising your equity, and you don't want to short that, right? And so you don't want to assume that you're going to get some sort of construction loan that you haven't even talked to any lenders yet. So that, you don't want to be surprised by that and then say, whoops, I need to go out and raise another round of equity, another equity raise. And so that's just going to kind of put you in a bad spot.
Absolutely.